everybody's expecting there's going to be an increase, for December. The question is what happens next year, but as important, what happens with that dot plot? And does it move at all, or does it just stay steady?
Right, we've been in this world since the introduction of the dots, right, just about 4 years ago, where they've been steadily coming down. In fact, they've been coming down at an accelerating rate, believe it or not, in the last year or year and a half. And I think that's going to stop. Right, and I think that's a big deal. The markets, for the first time really in a while, are now fully pricing in. Right, what we've seen is the Fed kind of marking to market their dots, and now the markets have finally caught up. Right, so as you pointed out before, the markets are right on line with the Fed expectations, which is the hike in 2 days, 2 next year, and then as much as 3 in 18 and 3 in 19.
What's going to be the significance of a dot plot that may actually be overtaken by the market, given that pretty much everyone we've heard from the FOMC has said they don't know how to price fiscal stimulus yet? Right.
Well, I think the sell-off in bonds is actually already getting to the point where it's in an oversold condition. Right. So I think it's already overreacted. If it gets above the dot plot, I think it's a big buying opportunity. Right. To us, the dots are not going to be achieved. Right, to assume that you're going to hike once last year, once this year, twice next year, and 3 times each in the following 2 years. So they think they're going to hike at an accelerating rate, and I think that's going to be really difficult. Our view is they're going to get the funds rate maybe to 2% this cycle, before stalling out and possibly cutting after that.
And at the heart of that question is, what has happened to the neutral rate over the last few weeks since Donald Trump was elected? The higher it moves up, it's around 0 now, the more room they actually have to hike. The lower it is, that means they don't really have that much room. Where do you see that R-start if we go into jargon here? Yeah,
so to me, that's a really long-term, secular, philosophical question. So that shouldn't move a lot, right? And our view is maybe that's 2%. It's not 2 7/8 where their long-term dots are right now. I think it's closer to 2. And it's really a function of where you think potential GDP is for the U.S. And we've been maybe a little bit under 2. And even if you have these pro-growth policies and deregulation and fiscal stimulus, I don't know if that materially changes our potential growth rate on a sustainable basis. So we're generally taking the other side of this really optimistic scenario.
We've had this shift in treasuries. One of the things that you're talking about over at Prudential is this rotation, not from equities to bonds, but the rotation within fixed income. Walk me through that right now.
Yeah, so everybody's thinking, it's been a real sell-off in bonds, right? And you see that on the rate side, but on the credit side, it's actually been a real strong rally we've seen in U.S. credit, right? So U.S. corporate bonds are hitting new lows here. High-yield bonds have snapped tighter since the election. They had widened about 50 basis points, their credit spreads, right before the election, and they tightened 30 basis points last week alone. So high-yield spreads are ratcheting tighter. But then you look around the world at other sectors, right? Municipal bonds have really underperformed. And I believe that's more a function of just retail investors panicking, but also emerging market bonds have really gotten clobbered. And if you look at European high-yield and corporate bonds, those spreads have widened as ours have tightened, right? So there are some relative value rotation opportunities that we're looking into in our portfolios.
And the question is, how much more of that rally is there? I hear a lot of rhetoric on the ground that when you have the cash repatriation coming back potentially under Trump, you're not going to have to go to the market and issue, and that's going to make an even bigger rally.
Yeah, so there's 2 sides of it. Well, there's 3. There's fundamentals, technicals, and valuations, right? The fundamentals arguably are improving a little bit as we have this tailwind on corporate earnings, for sure. The technicals, I think, are going to be a real positive story, right? More supply of treasury issuance, essentially, and presumably less supply, or at least less net supply of private sector debt across the board. And then you get to valuations, right? So high-yield spreads have really come in. I mean, there are a lot of high-yield bonds out there that have 2-handle spreads, meaning 250 basis points over treasuries, and they're starting to look a little less attractive, or at least fully valued. So you really have to pick your spots. One great stat I saw this morning, the non-commodity part of the high-yield market now has a higher spread than the commodity sector, right? Which is a flip-flop of what we saw earlier.
Boggle your mind.
Yeah, and that's an interesting phenomenon.
Michael, just quickly to button things up, I've got a good feel for what you've been buying. What have you been selling?
Yeah, so we've actually been reducing some exposure to these really high-quality, high-yield bonds that have done really well. Bank loans, which everybody loves. They're the darling of the market because they're floating rate. A lot of them are trading well above par now, par and a half, 101. And bank loans are like mortgages. They're callable every day at par. Right? And we've seen repricings really start to accelerate here, where a company can pick up the phone and lower the coupon you get on a bank loan. So we're worried about being on the other side of that. So that's something we're looking at. Emerging markets, we're being really selective, but we like a lot of different sectors in the credit markets.